Richard Dennis was a legend. He wasn't just a great trader, he was a teacher. Dennis believed anyone could learn to trade. To prove it, he ran an experiment. He found people with no trading experience. He called them his turtles. He taught them his system. And guess what? They made millions. The turtle traders became a Wall Street sensation. Their story is proof that with the right system, anyone can master the market. Richard Dennis's journey is an inspiration to anyone who dreams of conquering Wall Street. His story is a testament to the power of determination, intelligence, and a bit of daring. He didn't inherit wealth or connections. Born into a modest family, Dennis had to carve his own path in the world of finance. He began as a runner at the Chicago Mercantile Exchange. This entry-level job was far from glamorous, but it was a foot in the door. His job was simple run orders for traders, but Dennis was observant. He saw the chaos and the opportunity that lay within it. He watched. He listened. Every moment on the trading floor was a lesson. He absorbed the strategies, the mistakes, and the triumphs of those around him. He learned the language of the market, the numbers, the trends, the subtle signals that could mean the difference between profit and loss. In his late teens, Dennis started trading for himself. With a small amount of borrowed money, he took his first steps into the world of trading. He borrowed $1,600 and turned it into $200,000. This was no small feat. It was a clear indication of his talent and understanding of the market. That's when he knew he had a gift. But he also knew that talent alone wasn't enough. But it wasn't just luck. Dennis developed a system. He meticulously crafted a strategy that would guide his trades. He focused on trend following. This meant identifying and capitalizing on strong market movements. He looked for markets moving up or down strongly. When he found a trend, he would ride it, maximizing his profits. Then he'd ride that trend. Dennis's success was phenomenal. His ability to predict and capitalize on market movements was unparalleled. He made millions trading commodities. His success wasn't just in stocks, but in a variety of markets, showcasing his versatility and deep understanding of trading. He became known as the Prince of the Pit. This nickname was a testament to his dominance and influence in the trading world. But Dennis was more than just a trader. He was a philosopher. He believed in the power of knowledge and the potential of the human mind. He believed trading could be taught. This was a revolutionary idea at the time. Many thought trading was an innate skill, something you were born with, and he set out to prove it. Dennis started the turtle trading experiment, where he took a group of people with no trading experience and taught them his methods. The results were astounding. Many of his students went on to become successful traders in their own right, proving that with the right guidance and strategy, anyone could learn to trade. Dennis's legacy is not just in his own success, but in the success of those he taught and inspired. Imagine a surfer. They don't fight the waves, they ride them. That's trend following. Richard Dennis built his system on this idea. He looked for markets moving with strong momentum. These trends are like waves. They can be up or down. The key is to identify them early, then ride them until they change direction. Trend followers don't try to predict the future. They react to what the market is telling them. They use simple rules. These rules tell them when to enter and exit a trade. Emotions are kept out of the equation. It's all about following the system. This approach goes against traditional analysis. Many traders try to pick the perfect top or bottom. They get caught in short-term fluctuations. Trend followers ignore the noise. They focus on the bigger picture. Richard Dennis's trading system was incredibly simple. Richard Dennis, a legendary trader, believed that trading didn't have to be complicated. His approach was straightforward yet highly effective, proving that simplicity can often lead to success in the financial markets. It was designed to be easy to understand and follow. Dennis wanted his system to be accessible to anyone, regardless of their prior experience or knowledge in trading. He believed that with the right set of rules, anyone could become a successful trader. He broke it down into a set of rules. These rules were clear and concise, leaving little room for interpretation. By following these guidelines, traders could make decisions without hesitation, reducing the emotional aspect of trading. These rules became known as the turtle trading system. The name turtle came from Dennis's belief that traders could be trained just like turtles in a turtle farm. He proved this by training a group of novice traders who later became known as the Turtles to follow his system. They covered everything from market selection to position sizing. The rules were comprehensive, addressing every aspect of trading. This included which markets to trade, how much to trade, and when to enter and exit trades. Entry signals were based on breakouts. A breakout occurs when the price of an asset moves beyond a defined level of support or resistance. This is a key indicator that a new trend may be starting. A breakout is when the price of an asset moves above or below a previous high or low. This movement is significant because it suggests a shift in market sentiment, often leading to a new trend. This signals a potential new trend. When a breakout occurs, it can indicate the beginning of a bullish or bearish trend, depending on the direction of the breakout. Traders use this information to make informed decisions about entering the market. Exits were just as mechanical. Just as there were clear rules for entering trades, there were also specific guidelines for exiting them. This helped traders to lock in profits and minimize losses. Traders would exit a position if the market moved against them by a certain amount or if a specific time had passed. This approach ensured that traders did not hold on to losing positions for too long, which could be detrimental to their overall performance. The Turtles were taught to trade a diversified basket of markets. Diversification was a key component of the Turtle trading system. By spreading their investments across different markets, traders could reduce their risk. This could include currencies, commodities, and bonds. Trading a variety of financial instruments allowed the Turtles to take advantage of opportunities in different sectors and reduce the impact of any single market's volatility. Diversification helps to spread risk. By not putting all their eggs in one basket, traders could protect themselves from significant losses in any one market. It ensures that no single trade can make or break the portfolio. This approach to risk management is crucial for long-term success in trading. By following these rules, the Turtles were able to achieve consistent results and become successful traders. Richard Dennis knew that trading is a game of risk. He understood that the financial markets are unpredictable and that even the most experienced traders can face significant losses. The key to success in trading is not just about making profits, but also about managing risks effectively. Dennis believed that without proper risk management, even the best trading strategies could fail. Even the best traders have losing trades. It's an inevitable part of the trading journey. Losses are not a sign of failure, but rather a natural occurrence in the world of trading. What differentiates successful traders from unsuccessful ones is their ability to manage these losses and learn from them. They understand that every trade carries a certain level of risk, and they are prepared to handle it. The key is to manage those losses. Effective risk management involves setting clear rules and sticking to them, no matter what. This includes using tools like stop-loss orders to limit potential losses and protect the trading account. By having a solid risk management plan in place, traders can ensure that a few bad trades do not wipe out their entire account. The Turtle trading system had strict risk management rules. These rules were not just guidelines, but mandatory practices that every Turtle had to follow. The system was designed to instill discipline and consistency in trading, which are crucial for long-term success. The Turtles were taught that following these rules was more important than making a profit on any single trade. These rules were designed to protect traders from blowing up their accounts. By adhering to these rules, the Turtles could avoid catastrophic losses and ensure that they could continue trading even after a series of losing trades. The primary goal was to preserve capital and stay in the game for the long haul. The Turtles were taught to never risk more than 2% of their capital on a single trade. This rule was fundamental to their risk management strategy. By limiting the amount of capital at risk, they could withstand a series of losses without significantly impacting their overall account balance. This approach allowed them to stay calm and composed even during volatile market conditions. This means if they had a $100,000 account, their maximum loss on any trade would be $2,000. Stop-loss orders were crucial. These orders acted as a safety net, automatically closing a trade if the market moved against them by a predetermined amount. This helped to prevent emotional decision-making and ensured that losses were kept within acceptable limits. These orders automatically exit a trade if the price moves against them by a predetermined amount. This automation was essential for maintaining discipline and consistency in trading. It removed the emotional aspect of trading, allowing the turtles to stick to their risk management rules without hesitation. By using stop-loss orders, they could protect their capital and focus on finding the next trading opportunity. Dennis emphasized the importance of position sizing. Position sizing refers to the amount of capital allocated to a particular trade. It is a critical aspect of risk management because it determines the potential impact of a trade on the overall account balance. By carefully adjusting position sizes, traders can control their risk exposure and ensure that no single trade has the power to significantly harm their account. This refers to the size of a trade relative to the account balance. Proper position sizing ensures that traders do not overexpose themselves to risk. It allows them to diversify their trades and spread their risk across multiple positions. This way, even if one trade goes wrong, the overall impact on the account is minimized. The turtles were taught to adjust their position size based on their confidence in the trade and the volatility of the market. Higher confidence and lower volatility might justify a larger position size, while lower confidence and higher volatility would call for a smaller position size. This dynamic approach to position sizing helped the turtles to adapt to changing market conditions and manage their risk effectively.